Will the Bank of Japan sink or save markets and, of course, their owned Japanese yen? That is the question that we wrestle with today. Welcome to Macro Money. This is usd-jpy, head of global macro here at tastylive. And because we clearly have not had enough action from central banks creating havoc in the markets this week, there's another one that's coming. So brace yourselves, folks. There is more in the Department of Central Bank fireworks that might be on the menu. And today, of course, the focus on the Bank of Japan. This, until very recently, was something of an afterthought because the Bank of Japan hasn't changed policy in any kind of a meaningful way for decades, at least not in directional terms. But suddenly there is a very acute sense of speculation in the markets that perhaps now is the time. Maybe not this meeting, maybe not the next one, but that we are getting close to something here and the signaling for it is already emerging. So what we're going to do is we're going to unpack what that signaling is, see how it comports with economic reality in Japan and the likely scorecard that the Bank of Japan is actually looking at for making a determination that something needs to be done, and then have a look at what influence that might have on global markets, as well as, of course, the Japanese yen. So let's begin here with something that Bank of Japan Governor Kazuo Ueda said, because that really is the start of this latest bout of speculation. This was a quote that he had in Yomiuri Shimbun, which is one of the largest, one of the 5 top newspapers in Japan. And this came out over the weekend on September the 9th. He says, once we're convinced Japan will see sustained rises in inflation accompanied by wage growth, there are various options we can take. If we judge that Japan can achieve its inflation target even after ending negative rates, drumroll, we will do so. And this is really the kicker here. We can't rule out the possibility that we'll get enough information and data by year end. Now, of course, the markets read this as saying, wait a second, the Bank of Japan thinks it might have enough information to start getting off negative interest rates by the end of this year. What month is it? September. The end of the year is not that far away. But they're still capping interest rates. They're still saying that the 10-year government bond yield can't go above zero. Fine, they're giving it a 1% leeway to oscillate, but they are still very much in the markets trying to cap this yield. Surely they'll have to get rid of that before they start to raise interest rates, lest they shoot themselves in the foot and undermine their own policy of raising rates. Surely they have to get rid of this cap to let interest rates adjust to whatever policy they ultimately decide on with the target rate. So if they're going to end negative rates sometime by the end of the year or shortly thereafter, they've got to get rid of this yield curve control thing now. So the process might well be imminent here. Now, of course, Bank of Japan policymakers, after Ueda made this comment and the markets got duly excited, they came out and said, whoa, hold on a minute now. This is not what the governor meant. The governor meant that we'll have enough information to make any determination, whether we keep the negative rates or not, whether we keep yield curve control or not. Nobody is saying that there is an implication here that we'll have enough data to show that we need a move in a more hawkish direction. That, of course, has not dissuaded markets in any kind of a meaningful way, because as we can see here, the implied policy curve for Japan has been pointedly shifting in a more hawkish direction. So in the big dots there, or the big dashes, if you will, is where the curve was at the last BOJ meeting in late July. You can see that things have become more hawkish even before Ueda spoke. That's the little dots there. And of course, since he spoke, the curve has become steeper still. We are now looking at getting off negative interest rates within 3 months or so. You can see by the time we get to 6 months out, the rate is already 0. So the foundation, one might say, for getting off 0 rates or getting off yield curve control would need to happen somewhere between 3 to 6 months from right now. And then we actually see some meaningful tightening enter the outlook. We get almost 20 basis points within a year, almost 50 within 2 years, and then over 60 within 3 years. This is the highest interest rates we will have seen, if it happens, of course, from Japan in decades. This would be a tremendous sea change in global finance. So, does it in fact make sense? Is this where the Bank of Japan is going? Well, perhaps not so fast is the operative phrase here, because, of course, we do have to listen to what the governor is saying. He's saying, again, if we've judged that there's going to be a sustained rise in inflation accompanied by wage growth, then all of this comes into being an actionable conversation. But this, of course, directs us to seeing, well, where is inflation in fact coming from? Is it coming from wage growth? Well, maybe not. So if we look at the makeup of inflation in Japan, that big, big yellow area that you see there, overwhelmingly holding up inflation, that's food, not wages. Now, of course, one might make the argument that wages will eventually follow food because people will eventually go to their employers and say, hey, my cost of living is too high because food is too expensive, give me more money. And to some extent, that will happen. And this will move into wage growth, and indeed, to some extent, it has. But at the same time, that would mean that this needs to have some time to actually occur, and that this food inflation is, to some extent, sustainable. Well, besides the fact that there isn't much the central bank can do to curb food inflation, and this, of course, was the same case that we just saw from the ECB, where food inflation is the biggest issue in the Eurozone, from the Bank of England, where food inflation is the biggest remaining issue in the UK. Both of those central banks judged, look, we're pretty much done raising rates here because there's not anything that we're going to do with higher borrowing costs to get people to eat less. So why are we going to hurt our economies further? Let's back up. So too, for the Bank of Japan, if food inflation doesn't end up sticky, then is there really a reason to change course? Now, we're going to see CPI data updated later today, actually. It's meant to come down from 3.3 to 3% from July to August. But however that shakes out, whatever the makeup is in that breakdown, this breakdown is from July because, of course, the August data is not out yet. The probability that food inflation suddenly vanishes is, of course, next to nil. So this will be the main issue. And if we look at how it's developed over time, it does seem to suggest that food inflation has already peaked and is now heading lower. In the orange line, there is the UN Food Price Index, and about 7 months lagged to it is a Bloomberg estimate of global inflation. Now, of course, it makes sense that this is lagged. Different countries release CPI data at different increments, some quarterly, some monthly. There's inherently a data gathering lag, a reporting lag. whereas food prices move in real time with global markets. So not surprisingly, there is even just a reporting lag. And of course, market prices take time to filter into the economy, especially for something like food, where inputs need to get transformed, and there are shipping considerations and all kinds of delays. Contracts being negotiated, of course, ahead of time. So not surprising that there is a lag. And what this lag suggests, if we look at the food price index, is not just that some disinflation is already occurring, we can see that here clearly, but that more is ahead. That as global CPI catches up, we are going to see food inflation become less of an influence and fade from the calculus and get back to more normal levels. This is something that is going to happen at different speeds for different economies. For example, the lag in Japan might be a little longer because it imports more food, and so it probably has longer-term contracts in place when we and that's, of course, to ensure food security when you depend on external suppliers. There is probably a shorter time frame in sort of breadbasket type of economies where most of the food is domestic. So look at this 7 months thing as a broad-based indicator rather than something that's exact to the day, but it does seem to suggest that food inflation is increasingly fading as a concern. Now, does this portend sea change at the Bank of Japan? Well, if food inflation fades, then probably not, because Japan has had a very, very, very long history at this point of structural disinflation and even very, very, very aggressive monetary stimulus has not seemed to help. So what you see here is, in the red, normalized Japanese CPI going all the way back to 1973. And I've run it here through the latest data that we had to line up with this normalized BOJ discount rate. So we're just running into the beginnings of last year here and into last year. We've not captured the absolute up to the month data, but that's really hardly the point. Because what we see here is decades on decades on decades of structural decline in CPI. And of course, Japanese interest rates follow in tandem. They go down, as you might expect if inflation is falling, to try to bring it back up, to try to get it back to target. That's clearly not been successful, even with a very aggressive expansion of the balance sheet, so-called quantitative easing. You can see that in the yellow. So aggressive, as a matter of fact, that the BOJ balance sheet is now nearly 1.5 times the entire economy. We're hovering around, let's call it 130% of GDP for the Bank of Japan balance sheet. So they've created all of this liquidity to try to make money cheaper, to try to get some inflation into the system, at least for the past decade. You can see that biggest surge in the balance sheet here starts to occur about 2013, and it's not seeming to work. Now, why is that? Well, you can see here that accompanying this move is a very pointed decline in Japan's working age population, which at this point is in negative territory. So the growth rate has been slowing for decades and is actually now showing that the working age population is shrinking. Why is this a problem for inflation? Well, people generally have their prime consuming years before 50. So while they are in the prime of their working age, that's when they tend to do the most consuming. Because that's when you tend to have household formation, family building, outlays for all of those things, outlays for education, outlays for young children, you name it, that's when it happens, generally speaking. And of course, what drives economic growth? Consumption, for the most part. Household consumption is anywhere between 70 to 75% of economic growth for every major economy. So as you have this aging population, you have a demographic makeup that's inherently less likely to consume more and more progressively over time. Now it's actually shrinking the population, so the overall propensity to consume is actually getting even worse. By the time you get to this kind of a population, and Japan at this point, I think, has the oldest, though not the fastest aging population on average in the world. I believe the fastest aging is now something of a horse race between China and Korea. But certainly in Japan, the oldest on average population at this point. And of course, without consumption, there is no economic growth. And without economic growth, there is no pricing power in the economy. Inflation is generated by a pickup in demand. When there is demand for stuff, people that want the stuff have to compete on price. If I'm willing to pay more for the stuff than you are, then I get the stuff. Without demand, there is no inflation. And that, of course, is the issue structurally in Japan. So the question we must ask ourselves, if there is in fact to be some kind of a tectonic policy change in Japan, is there consumption? Is there pricing power that's actually getting built into this economy? Well, the demographics would certainly suggest not. And if we look at the second quarter GDP number here, the latest one that we have, we can see that although we had a tremendous jump in Japanese GDP, the annualized growth rate was as high as 6%. When we look at the actual quarter-on-quarter contributions to growth, this is what we see here. Growth ultimately ended up growing 1.2% in the second quarter, which is the latest numbers that we have. What we see here is that net exports overwhelmingly drive that growth, and private sector demand, i.e. consumption, actually fell, and not by an insignificant margin. So is there domestic demand? Well, probably not. Not to the kind of extent that the Bank of Japan would need to get off decades and decades and decades of easing, driven by decades and decades of demographic change, none of which shows any signs of changing. And clearly the Bank of Japan is prepared to be patient because they've been attempting this policy for years and trying to get inflation back up. So their threshold is probably fairly high for abandoning ship. Say what you will about the Bank of Japan, but trigger happy they are not. What does this jump in exports tell us? Well, just as you might surmise, we have had a boost here from a weak yen. If the yen is weak, then Japanese goods are cheaper for foreigners to buy. The purchasing power of foreign currency, once converted into yen, is greater if the yen itself is falling. And so there's been a surge in net exports. Not surprising. And that is because of the yen's very intimate relationship with global interest rates. You can see here going back some years, and we could go further, there is a very clear inverse relationship between the yen and where average global interest rates are going. I've looked at an average of the US, Eurozone, UK, and Australia to give a broad sample here, and looked at the 10-year yield, which tends to be the most liquid part of all the major yield curves. Different countries have different maturities that are liquid, but the 10-year tends to be sort of uniformly liquid across economies. So we can see here very clearly that as yields go up, the yen comes down, and ostensibly vice versa. So how does this feed into this story? Well, if interest rates in Japan have been perpetually going down and down and down because of all of what's going on the demographic side, and if the Bank of Japan has responded by a tremendous, eye-wateringly aggressive monetary expansion effort, as we can see with the balance sheet here, to try to stem that, and it hasn't worked, well, then it's really cheap to borrow in yen, because those interest rates haven't gone anywhere far from zero in 3-4 decades. What does that then mean? Well, as a consequence, what is called the carry trade strategy has emerged, whereby people go and they borrow in yen, which costs next to nothing, and then go and use that yen that they've borrowed to buy assets that yield more. For example, one might take their borrowed yen, convert them to dollars, and buy the S&P 500, even just as a broad-based index. And the dividend yield on that index will be greater than zero. So the dividend yield being earned, less the interest you are paying on your yen loan, which is next to zero, becomes income. Now, the way that this works is when interest rates start to go higher, that's typically the time when people start to pile into this strategy, because as long as the yield differential between Japan and the rest of the world is expanding, you are getting paid an ever greater amount to be short yen de facto, to have borrowed yen cheaply and bought assets where the rate of return is rising. This is why rising interest rates come with a weaker yen. But when this trend goes in reverse, when rate cycles end, when hawkish rate cycles end, and interest rates stop rising, you typically end up with the opposite situation. People start to unwind these positions because the end of a narrative is in sight. And so what they start to do is sell whatever assets they bought with borrowed yen, get back whatever currency that they needed to buy those assets, and have to sell that currency and buy back yen, so they have to cover their yen loans. That, of course, tends to lead the yen higher, because there's all of a sudden this upswell in yen buying. So typically, if interest rates stop rising, markets begin to anticipate that they will start falling as the next step, which means returns start to be anticipated to contract on this strategy, and people start to unwind. And as you start to build expectations for the end of policy tightening cycles and eventually their reversal in the opposite, more dovish direction, the yen tends to gain. This extends to generally risk-off market conditions, where when the markets start getting a little bit more risk-averse and start to anticipate that perhaps there is some sort of a pitfall down the road that central banks will need to respond to with stimulus, yen tends to gain. So, how does all this tie together? Well, the Bank of Japan is surely not confused about this dynamic. In fact, it is probably the least confused about it of anyone ever. So, it surely understands that when you have inflation that is fundamentally built on food, and there's a reason, by the way, why most core inflation readings in the world exclude food, because food is volatile, much as energy is. So when you typically look at core inflation, which is what central banks tend to pay attention to get an underlying sense of where things go, they tend to exclude food and energy specifically because food and energy specifically can be jumpy and obscure trends over a longer term. So if, in fact, the Bank of Japan is looking at this much as we are and says, well, this is mostly food inflation, am I really going to change policy? Probably not. Where does that Ueda quote come from? Why does he say the things he says and stoke speculation the way he has? Well, ostensibly, it is because of this very dynamic, because we've just been in a global tightening cycle for the better part of a year and a half, and interest rates have been going higher, and that's really hurt the yen. Here we have a monthly chart of the Japanese yen over the past 20 years, and we can see it is at its lows. It is at the lowest level that we've seen in a very, very long time. This, of course, presents an issue for the Bank of Japan, as it does for the Japanese economy, because the same way that the weak yen boosts exports, it also makes imports that much more expensive and feeds the very food inflation and other pass-through inflation, and generally makes life more difficult for consumers, increases the cost to everyone of anything imported, and Japan being an island, lots of things are imported. So, why did Ueda say what he said? Well, perhaps he said it because the Japanese yen was flirting with 10-month lows at the time that he said it. And this was definitely and immediately a cap on that move. Now, of course, the yen has since attempted to get back lower, but it's had a much harder time of doing it. So it seems like what Ueda was talking about wasn't so much attempting to signal a policy change, but instead was trying to use the bully pulpit to talk the yen up, to arrest runaway selling. This brings us to the BOJ policy announcement today. Will the Bank of Japan change course? Well, probably not, because none of the demographic elements of this story have changed. Would they change course solely for the yen? Probably not either, because they don't want the currency to be rising too quickly. That would be akin to tightening. And that's not what they want when they know that they still need long-term dovish policy. They just don't want things to get out of hand and for the yen to fall too quickly, because that would very quickly change people's cost of living calculus, and it would be much better for all involved if that were more of a gradual sort of effort. As a matter of fact, we had comments from Bank of Japan, or rather from the Japanese government's cabinet secretary, just on the heels of what Mr. Ueda said, and he was much more overt. This was Cabinet Secretary Matsuno, who said that Japan would not rule out any options to curb what it was judging to be excessive moves in the exchange rate. So ostensibly, what this is about isn't changing BOJ policy, it's about the yen. But if it is, then perhaps the yen has already turned or is beginning to turn. Because what we've learned from global central banks over the past 2 weeks is they are ready to be done with rate hikes. We have now heard this so far this month from the Bank of Canada, the Reserve Bank of Australia, We just heard it from the ECB, the European Central Bank, last week. We heard it this week from the Fed, which still tried to sound as hawkish as they could, but nevertheless signaled an end of rate hikes. We heard it just overnight from the Bank of England and the Swiss National Bank. All of these major central banks have suddenly gotten cold feet on raising rates further, ostensibly because what they see ahead is a global recession, whereby they've tightened to such an extent that the euro area is probably in recession already. The UK is probably not far behind. The situation in China, the world's second largest economy and 18% of global growth, remains dire despite them having exited COVID lockdowns back in December. They still can't get off the mat. The bubbly Chinese rebound story has completely fizzled. Meanwhile, in the U.S., the Fed has, hearing them this week, every intention of fighting inflation tooth and nail. They think they're done with rate hikes, but they're in no hurry to cut, which of course undermines the capacity for the world's largest economy, about a quarter of global growth, to offset the weakness elsewhere and brings a global recession that much closer. No surprise then that global central banks are saying, maybe we don't need to raise rates anymore. Maybe there's enough damage done. And looking at this dynamic, that would be consistent with the yen going higher with or without BOJ action. So really, all the Bank of Japan might have to do here is just remain vague and keep hope alive that maybe someday a policy change could possibly maybe come. And that would be enough in a market that already perhaps is of a mind that a yen recovery is coming. And so as we look at the price now hovering right at the recent cyclical support, perhaps this then is a meaningful bottom. And the telltale sign might well be the response to this Bank of Japan meeting. If the BOJ does not sink the yen in any kind of a meaningful way by opting not to change policy, by not giving any clear guidance that it's going to, because the evidence that it should is, let's generously call suspect, well then, that would be a very clear signal that indeed the market is intent on pushing the yen higher with or without the BOJ, and there's really no need for them to do much about it. So if they opt not to take action that would overtly strengthen the yen, but it doesn't come apart and holds up relatively well regardless, there's a bunch of underlying strength there, most likely. And some kind of a turn is probably not too far behind. And that is Macro Money for today. As ever, we are here Monday through Thursday every week right after Overtime, a show that I co-host with head of Futures and Forex Chris Vecchio here at Tasty Live, where we try to look at what's happening in markets after the Wall Street close, figure out what happened, make some sense of it, and maybe even attempt to figure out what happens next. I'm back on with Chris Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com. As a matter of fact, a write-up summary of this very analysis that we just talked about is there currently, if you want a bit of shorthand. And opining on Twitter, yes, Twitter, because I am stubborn, at Ilya Spivak. Thanks very much for joining. This is actually the last Macro Money for this week. We'll be seeing you next week. Happy trading. Take care.